Hi guys, today's video is going to concentrate on the technical topic of hidden divergence, purely because that's what's been requested of so many of you. Apologies it's taken so long to getting around to doing a video specifically on it, but that's what we're going to tackle today. So hidden divergence. It's different to your traditional divergence. Now we're going to use it to help us identify the timing for taking a trade in continuation of a strong trend. So normal divergence, the conventional divergence, is what we use to identify a potential reversal against a trend. Hidden divergence is something I use to help me identify the timing to take a trade in continuation of a trend. So the key element there is that we need to know what the trend is, and it needs to be very, very obvious. We need to find a currency pair where the trend is very, very clean and very, very obvious. If you're struggling to find the trend, you're going to struggle to find divergence, or in this case, today's topic, hidden divergence. So here I'm going to use the CAD Swiss as the best example for a strong trend, because for a good 8-9 months we had a very significant downtrend as illustrated by the chart here. No shadow of a doubt that this is in a very nice downtrend, so we can use our technical clues very, very powerfully because the trend is obvious. Now before we go into hidden divergence, I'm only going to look at hidden divergence as a one-off topic that you can use in combination with other factors. I will never ever take a trade just by spotting divergence or just by spotting hidden divergence. I will use it as a cluster of clues that help me identify a high probability trade, and most importantly the timing of when to enter a high probability trade. Now on previous videos you'll have seen the many other factors that I use to help me identify a high probability trade. Today we're just concentrating on hidden divergence, and as I'll always say to you, is go away and use some time on your own charts to spot hidden divergence, to practice it, and most importantly to get very good at applying it, and then go and apply it in your trades. Does it help you identify a better timing of your trade? If it does, then wonderful. So hidden divergence, again, as I mentioned, is to help us identify an opportunity to trade with the trend. So if we're seeing this trend here, it's very much down. So we're looking to use hidden divergence to find an opportunity to trade short. Now we're looking at the cyclicity first and foremost, because the cyclicity helps us identify whether we're getting convergence, divergence, or hidden divergence. So here we can see these lovely big phase ones, followed by quite a big phase 2, followed by a big phase 1, phase 2, phase 1. So we're seeing nice cyclicity, so it's very easy to identify the obvious highs and lows, which we'll use as reference points to determine whether we've got hidden divergence or not. So we're seeing these reference points. We've got a peak here, we've got a peak here, we've got a low here, we've got a low here, we've got a peak. So we can spot those and we can use them to our advantage. So hidden divergence is the opposite of conventional divergence. Now if we're looking at this here, we see a peak. If we're looking at this peak here, is it lower or higher? Now it's hard to tell, so I'm going to just have to quickly pop in a horizontal line there on the top of this original peak just here. Okay, so we pop that on just there, and we can see that peak is slightly higher than this peak here. So this peak here is a lower high. This is lower than the previous low, so previous lower high. That's what we expect in a downtrend. In a downtrend we should get a continuation of lower highs and lower lows. Now one of the key identifiers that potentially this is going to head down is this big high test bar. So price action is very strong here. It's finding resistance against the trend line and also the 50 moving average. So lots and lots of factors all coming together. But can we apply hidden divergence in this case? Well, we've already identified that the market has created a lower high than its previous one here. Now if we look at the stochastic, look what's actually happened. We've actually formed a higher high. So price has formed a lower high, but the stochastic has formed a higher high. That is hidden divergence in a downtrend. It's where the two are disagreeing with each other, and this is now saying the market wants to continue its move down, which is in a strong downtrend. It's wanting to head down, and now really is the timing that that's going to happen. Now, what I also like about this particular scenario here is that the stochastic has, as well as creating a higher high, it's also moved into overbought territory. So it then gives me confidence that it has the potential for a big move to come all the way back down into oversold territory. So we've got the hidden divergence, and the stochastic has gone above the 80% level and is in overbought territory. So all these factors coming together, the high test bar, the resistance against the trend line, the resistance against the 50 moving average, the hidden divergence which suggests a continuation of the trend is about to happen, all coming together. Again, confluence gives you confidence to take a trade. So again, just showing you that point, the market has put in a lower high. This high here is lower than its previous one, but the stochastic has put in a higher high. That is hidden divergence in a downtrend. Now, can we find any more examples of that? Now, the market obviously ran very nicely from that point. I think the key reason here, the key element here, is that we've got a strong downtrend. It's very, very obvious. If you're looking at a chart where the market is going sideways, these clues will not be as powerful as they are in a strong trend. So again, we see the market push down strongly. So let's just pop that in. So big phase one comes down and then it bottoms out before it starts to move back up again. So let's have a look at this area here where we get a little bit of a turning point. So do we get hidden divergence at this point here? So the market has come down strongly. This now is our new reference point. This is our new lower high because it's lower than its previous one. But look at the stochastic again. So let's just mark those levels in. So we're going to take these off. So we're going to mark the new level in. So price, if we take it from previous peak to where we currently are, most certainly a lower high. So we've got a lower high on the price action. Let's have a look at the stochastic. Go from point to point, and again it's done exactly the same as what we did before. It's come all the way back into overbought territory, but has also put in a higher high. It's higher than its previous peak, so it's doing the opposite to what price action is doing. So it's suggesting to us that the market wants to have another move down. We do get some nice price action reversal signs, and the market does head down from that point. Not as significant as the previous one, but still a nice efficient entry into the market. There's probably still potential for a good couple of percent there, or at least to move your stop to break even before it turns back around again. Now that's hidden divergence. We do get another example here of the conventional divergence. So you can see that from peak to peak it forms a higher high, but then we get the lower high. So that's your conventional divergence, which we've looked at many times before. So conventional divergence is when you're getting the opposite happen from peak to peak. So we're getting higher peaks but lower peaks. Hidden divergence is when we're getting lower peaks on the price but higher peaks on the stochastic. So it takes a little bit of practice and getting used to it because it's hard to differentiate between the two, but once you get it, it'll be very, very powerful, because then you've got the two sides of the market. Your hidden divergence will help you take trades in continuation of the trend, and then you'll have your conventional divergence, which will help you take trades in the opposite direction to the trend, so your reversal trades. So do we see any more scenarios? Well, let's have a quick look. Okay, so this is an example of where hidden divergence doesn't actually kick in. So we get the price action come down here. We get the market push back up. So look, we've got a lower high on price. So there's the previous peak. This is the new peak. It's put in a lower high, but it's put in a lower high on the stochastic. That's not to say we can't trade that. It's just it's not giving us that hidden divergence, which is another confidence factor that the market wants to continue its preceding trend, which in this example here is a strong downtrend. So it wasn't there. Do we get any more? Well, it looks like we do. So if we get this move down here, it creates its new lower high, new lower low, and then boom, comes all the way back up to form its next lower high. So we're referencing where we currently are, just here, to its previous peak. So that is definitely, this here is lower than the previous one. So it's put in a lower high. So we'll just mark that in there. There is a lower high. However, if we compare like for like on the stochastic, what's it done? It's put in a higher high. Not as optimum as the previous examples that we've looked at, because the stochastic hasn't come into overbought territory. However, it's still very, very powerful. in terms of the message that it's giving us, but not as powerful as these examples here because it hasn't quite pushed above the 80% overbought ratio. So again, another nice example there of giving us help with the timing, because as we see, whenever we see this hidden divergence, it's really not exactly, but it's giving us a very nice zone of where price is likely to turn from. So that's very, very powerful because it helps you massively with the efficiency of your entry. Again, we see the market pushes down very, very strongly, and what happens then is that the market, it breaks out of its channel eventually, and now what are we seeing? Well, we're seeing a strong trend to the upside. So we've had a very strong downtrend, and now we're seeing a very strong uptrend. It's come up, come down, started to put in higher lows, and now higher highs. So we've got this scenario here where we've got a strong uptrend and we've got the previous low. So we're looking at this hidden divergence now. We've looked at it in a downtrend. Let's have a look at it in an uptrend. So we've got this low here and we've got this current low here. This is higher than its previous low, as illustrated by this line here. We've got a higher low just here. We get this lovely reversal inside buyer bar just here, giving us a hint that the market is potentially wanting to head higher. So as it comes down, what are we looking for? Well, now we've got to flip the rules over, because in a downtrend we were looking for a lower high on price but a higher high on the stochastic. Now what we're looking for is a higher low on price but a lower low on the stochastic. So we've got scenario one. This is higher than its previous low, so it's put in a higher low. Now look at like for like. So if we come here, we go from this point here to this point here, and I'm ignoring everything in the middle because I can't see any clean cycles there. This is the most obvious low point here, all the way up to the top. So we take that reference point just there and we come to the current reference point, and the market has put in a lower low on the stochastic. The stochastic has put in a lower low, so a higher low on price but a lower low on the stochastic. And what's great about this is it's also in oversold territory, so it gives us confidence that the market wants to head, not only wants to head higher, but also has the room to give us a nice profit potential to go all the way back up into overbought territory. So a really nice example on one currency pair of how in a very strong downtrend we saw lots of hidden divergence examples giving us efficiency to trade with the trend, and then as the market moved into its uptrend, we saw that the hidden divergence was giving us powerful opportunities to enter on the market cycles and the market swings in an uptrend using the hidden divergence to the upside. Again, don't just trade with hidden divergence. Combine it with other factors, so look for your other factors. Price action is the most important, so you need to see a price action giving you a sign that it wants to reverse. So your low test, your high test, your inside bars, etc. Look for your horizontal levels of support and resistance. Look for your Fibonacci retracements, Fibonacci extensions. Look for your support in terms of your moving averages, and bring them all together. Confluence of factors will give you confidence to take a trade. High probability trades. Again, will you see hidden divergence and the trade not quite work out? Of course you will. But as we've seen with a lot of these examples, the winners are very significant, so that you can look to push yourself into positive reward to risk. So your winning trades are bigger than your losing trades. That very simple calculation, having your winners bigger than your losses, and you net a profit at the end of a period of trading. So that's a really classic example using one currency pair. Again, the trend is very, very important. We can have a look at some other examples. So let's maybe have a look at, I think there was a trade that I gave, a suggestion on a trade that I gave to you guys a while back, which was very, very powerful. Was that, I think it was pound CAD, if I can remember off the top of my head. Yes, pound CAD, all the way back in February. So if you go back through the videos, you'll have a video where we analyse this scenario here. Again, look at the trend leading into this move. Massive uptrend, very, very powerful. I think at the point that we were looking at was around about here. So we had a big move up, fantastic, and then we had a big move down. So if we're looking for hidden divergence in an uptrend, remember, we're looking at the lows. In a downtrend, we're looking at the highs. In an uptrend, we're looking at the lows. This current low is higher than its previous low. I'm ignoring all this because it looks sideways, so I'm taking this as a previous low. Let's have a look at the stochastic. Bang, there we go. Fantastic. The stochastic has come all the way back to oversold territory. It's lower, the low is lower than its previous one, so higher on price, lower on stochastic in the oversold territory. Do we have some other clues there? Absolutely we do. We have a little bit of a soft horizontal level, so these peaks here, resistance becoming support. We have price action, low test bars. I'm sure there's a Fibonacci on there as well, so we can probably draw the Fibonacci from this low point here to this high point, and bang, comes down to the 382, between the 382 and the 50%, so wonderful. Nice room to get back up to the previous highs, and the market gradually gets back up there. And as you can see, because we like to see it in oversold territory, look, it has to go all the way back up, which gives us that potential for a nice profit. That's why I really like when the stochastic is either in oversold or overbought territory, depending on what we're using. So that's a nice example that we looked at a while back. Hopefully now, by using the example of hidden divergence, you start to see how powerful that is. Have a look at another one. Was it, I think it was Aussie CAD from a while back. So let's have a look at that. So it was in a nice channel, topped out at the top of its channel, came all the way back. So we saw the market move very nicely to the upside, pull back to put in that higher low. And as we can see, compare like for like, dum dum, dum dum, doing the opposite. Higher low on price, lower low on the stochastic, and the stochastic in oversold territory. The market then moves much higher. Again, combine it with your other factors. I don't know, let's just take a random chart and have a look. Euro. Well, you look at the Euro chart, and for me, I can't see much of a trend there. Little bit down, little bit up, sideways, bit down. So for me, I can't really be looking to trade a trend or hidden divergence when I use it to trade with the trend when I can't identify a trend. So let's just go back and try and find a bit of a trend. So there's a bit of a nice trend there, but a bit wishy-washy, sideways. Okay, that looks a bit nice. I can see clean cycles, and with clean cycles I can then have clean identification of what the stochastic is doing. So big move up, phase 1, phase 2, phase 1, phase 2. Okay, so let's have a look at this one, because this is nice because it bounces off the 50 moving average. Nice level of support, lovely low test bar there. So we've got higher highs and higher lows. For hidden divergence, if we want to take this with the trend, we want to be looking for hidden divergence. So first let's look at the lows. They are creating higher lows. This is higher than its previous low. Wonderful. That is a sign that the market wants to continue. However, can we get our timing right? Well, the hidden divergence will help us when the market is ready to turn and head higher. So we look at this here. Bang, there we go. The market has put in a higher low. The stochastic has put in a lower low. And to add emphasis to that, the stochastic is also in oversold territory, meaning that there is potential for a nice move higher. And as we see here, very significant move to the upside, and certainly some pips profit in that particular scenario there. But again, what was the key thing that identified and zoomed my eye into this? Well, it was strong trend and clean cyclicity. With strong trends and clean cyclicity, it's so much easier to find the clean identifiers on the stochastic. So there's loads and loads of examples. I can continue going through examples, but I'd prefer you to go and do a little bit of work going through examples of your own. Find a chart, find a clean trend, find clean cyclicity, and then look for your hidden divergence. Look to compare the peaks on price in the downtrend to the peaks on the stochastic, and in an uptrend, look to compare the lows in comparison to the lows on the stochastic. Look for if it's in overbought or oversold territory to emphasize the point, and then see how it pans out afterwards. What you'll notice is a lot of the moves that do work out are very significant, and the ones that don't, obviously you're using risk management to limit any potential losses on that trade to a minimum. So hidden divergence, very, very powerful when trading with the trend. If you've got very good at using conventional divergence, now you have the tools in your toolkit to trade the trend and to trade the reversal, which means you've got most market conditions covered. The only scenario that haven't is really looking at trading within a range, but we can look at that at a later date. So I hope that helps. Hope that clarifies some questions you may have had, some some challenges with this particular topic, and go away and use it and apply it and become brilliant at it, because it's very, very powerful stuff. Cool. So I'm going to wrap up there. Just a little note that I'm going to be overseas for the next couple of weeks, so I'll be a little bit quiet on the update front. So just bear that in mind. For those of you that have just recently joined my Trade Alert subscription, don't worry, I'll still be trading. The beautiful thing about trading is that we can take our office wherever we may go. So I'll be still doing my own trading. I'll be sending out the alerts, so don't worry about that. And then when I get back, I'm going to be really concentrating on really building the Springboard brand. So I've got some very exciting things to share with you going forward. I want to share my journey, where I want to take Springboard, and how you can get involved in the journey. So that'll all be coming in the next few weeks and months. But until then, enjoy the fine weather for those of you in the UK that we're having, and have a great trading week, and I'll speak to you very, very soon. Cheers.